December 9th, 2025. A financial bombshell dropped that should have dominated every trading floor conversation on Wall Street. JPMorgan Chase, the banking giant that's been accused of silver price suppression for over a decade, the same institution that wrote a check for $920 million to settle precious metals manipulation charges, has just executed the most stunning reversal in commodity market history. Here's what happened. Between June and October of this year, they didn't just close their massive 200 million ounce paper short position. They went nuclear on the buy side. 750 million ounces of physical silver. Not derivatives. Not synthetic exposure through ETFs. Actual, tangible, deliverable metal sitting in secured vaults. Let me give you some context on that number. That's roughly equal to one entire year of worldwide mining output. That's more silver than some developed nations keep in their strategic commodity reserves. At current market prices, we're talking about a $22 billion capital deployment. And here's the kicker. That's their cost basis before silver makes its next major move. This isn't some boutique hedge fund making a contrarian play. This is JPMorgan Chase, a $3.9 trillion financial behemoth, allocating capital at a scale that screams they're not positioning for a trade. They're positioning for a complete market transformation. Think about what makes this so significant. For the better part of 2 decades, JPMorgan has been the dominant bearish force in silver markets through sophisticated derivative strategies. Veteran traders have their own term for it, the JPMorgan short. It's practically folklore in precious metals trading circles. Every single time silver attempted to break through key resistance levels at $30, $35, or $40 per ounce, massive sell orders would flood the COMEX exchange out of nowhere, crushing bullish momentum and triggering stop losses that sent retail traders running for cover. Now, zero short exposure. For the first time in modern commodity market history, JPMorgan is simultaneously long physical metal and long paper contracts. This isn't portfolio diversification. This isn't risk management hedging. This is a complete strategic pivot. They've switched teams because their internal analysis tells them exactly what's about to unfold. Here's what JPMorgan's analysts figured out before the rest of the market caught on. The mathematical dynamics have shifted so dramatically that paper manipulation strategies no longer work. Let me walk you through the 3 critical factors that are creating an inescapable trap. Domino number 1. Physical supply has evaporated. Silver lease rates, which represent the cost financial institutions pay to temporarily borrow physical metal from holders, exploded to 35% in October 2025. Stop and think about what that number actually represents. Major banks are so desperate to get their hands on physical silver that they're willing to pay 35% annualized interest just to borrow it for a few months. A commodities desk source told Bloomberg, and I'm quoting directly here, "Nobody's got silver. Lease rates are hitting 20 to 30% if you can even find someone willing to lend." This isn't typical market volatility. This is what structural failure looks like before it becomes headline news. Domino number 2. COMEX inventory collapse. COMEX registered inventories, that's the metal actually available to fulfill delivery against futures contracts, have crashed to levels not seen in 15 years. Meanwhile, open interest has surged to unprecedented highs. The exchange is now running at a 244 to 100 ratio of paper claims to physical inventory. Translation: for every single ounce of silver actually sitting in a COMEX-approved vault ready for delivery, there are 2.44 paper contracts claiming ownership rights to that exact same ounce. That's not a functioning commodity market. That's a game of musical chairs where 60% of players won't find a seat when the song ends. Domino 3. Industrial demand is non-negotiable. Solar panel manufacturing, electric vehicle production, 5G network infrastructure, hyperscale data centers. These sectors consumed 1.2 billion ounces in 2025 alone. Unlike speculative investment demand that can evaporate during recessions, industrial consumption is contractually locked in years ahead of time. Manufacturers cannot produce solar cells without silver paste for electrical conductivity. They cannot fabricate advanced semiconductors without silver interconnect materials. They cannot build automotive electrical systems without silver alloy contact points. The assembly lines keep running. The procurement contracts don't get canceled. The consumption is built into global industrial expansion for the entire next decade. JP Morgan examined these three converging data points and reached an unavoidable conclusion. The suppression strategy is mathematically finished. The institution that profited for decades from shorting silver just committed $22 billion to go long because the fundamental equation has permanently inverted. And here's the detail that should terrify anyone holding paper silver exposure or sitting on the sidelines waiting for better entry prices. JP Morgan's position flip coincided precisely with the United States Mint announcing silver coin supply constraints. Think about the implications. The United States Mint, backed by the world's reserve currency with direct sourcing relationships to every major silver refiner and mining operation globally, cannot acquire enough metal to meet retail demand for American silver eagles. If the U.S. Mint, with all its institutional advantages, is struggling to source physical silver, what probability does an average retail investor have when they attempt to convert their SLV shares into actual deliverable metal during a crisis? This is the signal. When the most powerful predator in the silver market closes its short book and goes long with 750 million ounces, they're not making a directional price bet. They're reading the mathematical endgame and securing position before it becomes obvious to mainstream participants. Silver is trading at $64.47 as I record this. That's already an all-time record high in nominal terms. But if JP Morgan is comfortable deploying $22 billion at these exact price levels, what do their proprietary quantitative models project for silver when the supply crisis becomes undeniable to the broader investment community? The crucial difference between this situation and 1980, when the Hunt brothers attempted to corner silver and spectacularly failed, comes down to one fundamental distinction. The Hunts used leverage and paper contracts funded through credit facilities. JP Morgan is accumulating physical bars purchased with balance sheet capital. Regulators forced the Hunt brothers to liquidate by changing margin requirements and freezing their credit access. But you cannot force JP Morgan to sell physical inventory sitting in their own custody. There's no margin call on metal you outright own. There's no regulatory framework to mandate sale of privately held commodity stockpiles without invoking Defense Production Act emergency powers. The betrayal isn't that JP Morgan manipulated silver downward for years. We already had proof of that. They paid nearly $1 billion in settlements and kept operating. The real betrayal is that they knew precisely when the manipulation would become mathematically impossible, and they positioned themselves to profit massively from the explosion while retail investors are still waiting for CNBC confirmation that it's safe to buy. Let's rewind to where this accumulation strategy actually originated. 2011. That's when JP Morgan was quietly approved to establish their own COMEX silver depository, becoming one of only 5 authorized vault facilities at that time. They started with exactly 0 silver inventory. By 2017, just 6 years later, they controlled 112.5 million ounces out of total COMEX inventory of 213.3 million ounces. Run those numbers for a second. That's 53% of all the silver backing the world's largest paper derivatives exchange, held by a single bank with a documented, prosecuted, legally proven history of price manipulation. This wasn't random market participation. This wasn't passive institutional rebalancing. This was a multi-year coordinated strategy executed with surgical precision to position at the absolute control point of global silver supply chains. Analyst Ted Butler tracked their accumulation patterns for years and discovered something remarkable in the delivery data. JP Morgan systematically stood for delivery on COMEX contracts, meaning whenever they held long positions, they demanded physical silver instead of rolling contracts forward or accepting cash settlement like most participants. Between 2015 and 2016 alone, they took net delivery of 51 million ounces. In March 2017, they stopped 2,689 contracts representing 13.4 million ounces, significantly exceeding COMEX position limits that theoretically exist to prevent market manipulation. Ted Butler actually filed formal complaints with the CFTC about this pattern. Nothing happened. No investigation. No enforcement. No public statement. Why? Because JP Morgan wasn't breaking the system at that point. They were silently preparing for the day when the system would break itself under mathematical impossibility. Fast forward to 2025, and official government data now confirms what Butler warned about for years. The Commitments of Traders report, That's the CFTC's weekly position snapshot showing who's positioned where in futures markets, reveals something extraordinary happening in real time. In a single reporting week this year, the commercial net short position, primarily the major banks like JPMorgan, HSBC, and Deutsche Bank, dropped by a staggering 15,564 contracts. That represents 77.8 million troy ounces of paper silver obligations. For context, analyst Ed Steer, who's monitored silver manipulation for 2 decades, estimated the commercial short reduction would be 5,000 to 10,000 contracts maximum based on historical patterns. The actual number, 15,564 contracts. More than triple even the most optimistic bullish projection from someone who analyzes this data daily. Simultaneously, managed money, that's the CFTC category for hedge funds and speculators, went aggressively net short. This is exceptionally rare and historically significant. Typically in commodity markets, speculators are long betting on price appreciation, while commercials are short hedging their production or managing price risk. Now the positions have completely inverted. Smart money with inside information is long. Dumb money chasing momentum is short. Analyst John Rubino called this pattern hyper-bullish and stated, "This is something very seldom seen, and the commercial imbalance is also highly unusual." Translation: the banks have stopped fighting the silver rally. They've stopped using derivatives to cap advances. They're now positioned to ride the wave they spent decades suppressing. But here's the most damning evidence that the physical market has already fractured beneath the surface where most investors aren't watching. October 8th, 2025. A buyer, widely speculated in trading circles to be India though never officially confirmed, placed an order for 1,000 tons of silver on the London market. That's approximately 32 million ounces. To be completely transparent about scale, that's not even 4% of annual global mine production. It's a substantial institutional order, absolutely, but not unprecedented by historical standards. The result? The London Bullion Market Association reported 844 million ounces of silver in their vault system at that time. Yet the market couldn't fulfill a 1,000-ton order without complete system paralysis. Silver lease rates instantaneously rocketed from 0.25% to 200%. Every major trading desk simultaneously withdrew liquidity. Swiss refiner Metallurg, which operates in 17 countries and is one of the 3 largest precious metals processors globally, announced they would not return to silver trading until January 2026. Let that register for a moment. The LBMA claimed to have 23,926 tons of silver sitting in London depositories. An order for 1,000 tons, barely 4% of reported inventory, caused total market seizure. Why would that happen if the metal truly exists in available form? Because according to LBMA accounting standards, 4/5 of that reported inventory is allocated to ETF holdings like SLV and theoretically unavailable for immediate sale or delivery. But here's the critical question nobody in financial media is investigating. Do those ETFs actually own that silver unencumbered, or is it leased out to banks using the same physical bars as collateral for multiple claims? The October 8th freeze answered that question definitively. The silver isn't there. Not in the quantities reported on paper. Not available for delivery on demand without triggering systemic stress. Between June and October 2025, JPMorgan executed their complete position reversal with the kind of precision you'd expect from an institution that trades trillions of dollars across global markets daily. First, they systematically closed the short position. 200 million ounces of paper contracts that had been the primary downward price pressure for years were bought back over a 4-month window. That alone would have been extraordinarily bullish for silver prices, removing the single largest artificial suppression force from the market. But they didn't stop there. They simultaneously deployed the capital freed from closing those shorts to accumulate physical metal at a pace that's almost incomprehensible. In just 6 weeks during this period, according to commodity analysts tracking COMEX warehouse receipts, they added 21 million ounces to their stockpile. That's 300,000 ounces per day. Every single day, for 6 weeks straight. Where did they source that volume of physical silver while the market was already demonstrably tight? COMEX registered vaults. ETF custodian inventories like SLV's holdings. Private off-market transactions directly with mining companies and industrial holders. When you're JPMorgan Chase with $3.9 trillion in assets and relationships with every major financial institution on the planet, you can make calls that retail investors cannot. You can offer premiums that smaller buyers cannot match. You can structure deals that pull metal out of supposedly unavailable inventory. Critics observing this unfold might reference the Hunt brothers in 1980 as evidence that silver corner attempts always end in failure and regulatory intervention. It's a reasonable comparison to examine. But here's exactly why JP Morgan's position is fundamentally structurally different in ways that matter enormously for how this resolves. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, accumulated approximately 200 million ounces through futures contracts and massive leverage. They were using credit lines and borrowed capital to control paper positions far exceeding their actual net worth. When silver hit $50 per ounce in January 1980, regulators changed the rules mid-game to stop them. COMEX raised margin requirements. They imposed new position limits specifically designed to target the Hunts. They even implemented Silver Rule 7, which effectively prohibited new long positions while allowing shorts to remain. The government froze the Hunts' credit lines, called their margins, and forced liquidation. The entire scheme collapsed within months. JP Morgan holds 750 million ounces of physical metal purchased with their own balance sheet capital. Not borrowed money. Not leveraged positions. There are no margin calls on metal you physically possess in your own vault. There's no regulatory mechanism in U.S. commodity law to force JP Morgan to sell bars sitting in their warehouse. More importantly, and this is the crucial distinction, JP Morgan isn't trying to artificially corner the market through manipulation. They're simply positioning ahead of a supply deficit that's now in its sixth consecutive year and accelerating. The Silver Institute, the industry's most authoritative source for supply and demand data, projects a 117.6 million ounce deficit for 2025, the sixth straight year where global consumption exceeds mine supply. That's not speculation. That's not a forecast that could be wrong. That's structural, observable reality based on industrial consumption data and mining output reports. Let's do the exact mathematics that JP Morgan's quantitative analysts performed before their executives approved deploying $22 billion of shareholder capital. These are published figures from the Silver Institute, official COMEX exchange data, and industrial consumption reports that any investor can independently verify. Start with supply. Global mine production for 2025 totals 835 million ounces according to the Silver Institute's annual report. That sounds substantial until you examine the demand side of the equation and realize the numbers don't balance. Industrial consumption alone, 1.2 billion ounces consumed in 2025. Solar panels, electric vehicles, 5G infrastructure, data centers, semiconductor manufacturing. These aren't discretionary consumer purchases that people can postpone during economic uncertainty. These are supply chain requirements locked in 3 to 5 years ahead through long-term contracts. You cannot build a solar panel without silver paste for conductors. There's no economically viable substitute at current price levels. You cannot manufacture smartphones without silver in circuitry and touch sensors. You cannot produce automotive electrical systems without silver alloy contacts. The factories operate 24/7. The purchase orders are already executed. The consumption is embedded into global infrastructure build-out for the entire next decade. Investment demand adds another massive layer. ETF inflows surged throughout 2025 as investors sought inflation protection. Retail buyers are purchasing physical coins and bars at premiums $10 to $15 above spot price due to tight supply at mints and dealers. The structural deficit, 117.6 million ounces for 2025 alone. But here's what transforms this from problematic to catastrophic. This isn't a one-year anomaly caused by temporary disruption. This is the sixth consecutive year that global demand has exceeded mine supply. That means above-ground inventories stored in vaults are being systematically drawn down every single year. Every year there's less silver sitting in warehouses available for future delivery. And every year more silver gets permanently locked into industrial products that will never be recycled. Now here's where the mathematics become inescapable. COMEX registered inventory, the metal actually available for delivery against futures contracts, has collapsed to approximately 38 to 40 million ounces as of Q4 2025. Meanwhile, Open interest, which represents the total number of outstanding paper contracts, exceeds 244% of that physical inventory. Translation: if even 41% of contract holders standing for delivery demand physical metal instead of cash settlement, COMEX cannot fulfill those delivery obligations with existing registered inventory. The exchange would face a binary choice: source metal from eligible inventory, which requires obtaining permission from owners to transfer it to registered status, or admit publicly that they cannot fulfill delivery on contracts they sold. That's not market volatility. That's structural insolvency. JPMorgan deployed $22 billion at prices averaging $60 to $65 per ounce. Why would they do that if silver is expensive at all-time highs? Because their proprietary models project something dramatically higher, and they want position size secured before it becomes obvious. Let's use historical precedent to establish baseline targets. In 1980, silver peaked at $50 per ounce during the Hunt brothers crisis. Adjusted for official CPI inflation using government methodology, that equals approximately $185 in today's purchasing power. But that calculation uses heavily manipulated CPI figures that exclude food and energy and use hedonic adjustments to understate real inflation. If you use actual inflation metrics, the methodology the Bureau of Labor Statistics used before they changed calculations in the 1990s, 1980's $50 silver equals roughly $600 per ounce today. That's not conspiracy mathematics. That's John Williams' shadow stats calculations based on consistent methodology. But I don't think JP Morgan's being conservative in their internal projections. Consider this critical difference. In 1980, the Hunt brothers attempted to corner silver using 200 million ounces of leveraged paper positions for speculative profit. Today, industrial demand alone consumes 6 times that amount annually. And it's not speculative. It's structural consumption driven by technology transformation that cannot be reversed or substituted until silver reaches $2,000 to $4,000 per ounce, which is the price point where alternatives become economically viable in most industrial applications according to materials science research. JP Morgan isn't betting on $600 silver as a speculative price target. They're positioning for the mathematical endpoint where paper claims collapse entirely and price has to rise to whatever level is necessary to ration the limited physical supply among only the highest value industrial users who literally cannot function without it. Conservative target based purely on supply-demand fundamentals: $100 to $150 per ounce by late 2026. Moderate target if COMEX experiences delivery stress forcing cash settlements: $200 to $300 per ounce. Extreme target if paper markets break entirely and physical premiums explode: $400 to $600 plus per ounce. At $100 silver, JP Morgan's 750 million ounce position is worth $75 billion. That's a $53 billion profit on their $22 billion investment. At $200 silver, they're looking at $150 billion in value, a $128 billion gain. Those are the kinds of institutional returns that justify deploying massive capital at what everyone else calls all-time high prices. 3 specific dates should be permanently marked on every silver investor's calendar because these are the inflection points where mathematical pressure reaches breaking points. January 2026. 3 critical events converge in the same month. First, China's new silver export control regulations take full legal effect. These rules, officially announced in MOFCOM Announcement 2025 No. 68, give the Chinese government explicit authority to restrict silver exports for national security reasons without advance notice. China exported 660 tons in September 2025 alone, a record month. If Beijing decides to curtail or completely halt exports, that removes significant global supply overnight. Second, also in January, JP Morgan must return the 4,000 tons of silver they reportedly leased from ICBC, Industrial and Commercial Bank of China, back in October to help meet delivery demands from the order that froze the London market. If JP Morgan cannot source 4,000 tons to return without causing market disruption, they face either paying enormous penalty fees to extend the lease or defaulting on a lease with the world's largest Chinese bank. Neither scenario suggests stability. Third, Metalur, the Swiss refiner that completely withdrew from silver trading in October, is scheduled to return to the market in January. Will they find adequate feedstock to process when they return? Or will their return reveal that the supply shortage has actually worsened during their absence? February 2026. The next major COMEX delivery cycle begins with the March 2026 contract. This typically sees significant delivery activity as the first major contract of the new year. With registered inventory at 15-year lows and open interest at near-record highs, this delivery period will be the first major stress test of whether COMEX can still function as a legitimate physical delivery market. If even a modest percentage of long position holders stand for delivery and demand physical metal instead of rolling contracts forward, COMEX faces that binary choice I mentioned: source metal from outside the exchange system at whatever price is necessary, or admit they cannot fulfill delivery obligations on contracts they sold. Here's what JPMorgan knew that they deliberately didn't tell retail investors while they were accumulating. The paper silver market is already mathematically broken. The October 8th London freeze proved it beyond doubt. The 35% lease rates proved it. The US mint coin shortage proved it. The supply deficit mathematics proved it. While they spent decades telling the world through their trading desks and research reports that silver was going lower, while they actively manipulated prices downward through enormous concentrated short positions, they were simultaneously building the world's largest physical stockpile in secrecy. That's not just sophisticated market positioning. That's institutional knowledge of an inevitable endpoint being deliberately hidden from retail investors until the institutions finish accumulating at suppressed prices. The $920 million fine JPMorgan paid in 2020 for precious metals manipulation? That wasn't justice being served. That was simply the cost of doing business. They made billions suppressing silver prices while quietly accumulating physical metal cheap. Now they're positioned to make tens of billions more when the manipulation mathematically ends because the supply deficit makes continuation impossible. Silver is at $64.47 today. Every mainstream financial analyst will tell you it's too expensive. You missed the rally. Wait for a pullback to $50. Meanwhile, JPMorgan just deployed $22 billion at these exact prices. Who do you trust? Financial media whose business model depends on retail investors staying complacent, or the bank that manipulated silver for decades suddenly going all in long with their own money? The betrayal is now complete. They suppressed prices through manipulation while retail sold in fear. They accumulated the largest physical position in history while analysts said silver was dead. They flipped their entire position from short to long while media said it's too late to buy. Now they simply wait for mathematics to do what manipulation can no longer prevent: force silver to revalue to a price that reflects actual physical scarcity instead of paper abundance. The question isn't whether this happens. The supply deficit and COMEX inventory mathematics make it inevitable. The question is whether you understand the signal JPMorgan just sent, or whether you'll wait for mainstream financial media confirmation after the price has already doubled or tripled from here. 750 million ounces, $22 billion deployed, 0 short contracts remaining. When the biggest predator switches sides, it's not a warning. It's a declaration that the game has fundamentally changed. If you found this analysis valuable, make sure to subscribe and hit that notification bell so you don't miss future updates as this story continues to develop. The next few months could be absolutely critical for silver markets, and I'll be tracking every development. Thanks for watching, and I'll see you in the next one.